In January 2025, a Federal Reserve announcement inside a building in Washington D.C. caused Bitcoin to lose thousands of dollars within a single hour. The same institution that helped push Bitcoin past $100,000 had now become the force pulling it sharply back down from that historic peak. Welcome to the Secret Treasury, where money, influence, and history intersect. Subscribe to trace the flow of power behind the headlines. To understand this story, you must travel back to 1913 when a quiet law signed in Washington, D.C. changed American finance forever. On December 23, 1913, the United States Congress signed the Federal Reserve Act and handed a small group of officials enormous financial power. Inside a building in Washington, D.C., those officials received one extraordinary tool: the ability to raise or lower interest rates at any time. A higher interest rate makes borrowing money expensive and slows the movement of dollars across the entire United States economy significantly. A lower rate makes borrowing cheap and pushes money into stocks, real estate, and risky investments all across the country. For over a century, this single tool shaped the rise and fall of banks, businesses, and entire national economies around the world. Then in 2009, something arrived that no Federal Reserve official had ever encountered before: a digital currency known as Bitcoin. A person or group using the name Satoshi Nakamoto published a 9-page document describing money that no central bank could ever control. Bitcoin had no headquarters, no president, no vault, and no printing press. It existed entirely on computer networks spread across the globe. In 2010, a programmer in Florida paid 10,000 Bitcoin for 2 pizzas, believing those digital coins were nearly worthless at the time. Those same 10,000 Bitcoin later surpassed $1 billion in value, making it the most costly food purchase in all of financial history. For years, serious investors in office buildings on Wall Street called Bitcoin a digital experiment not worthy of real financial consideration. That view began changing in 2020 when major corporations placed Bitcoin on their official company balance sheets for the very first time. A Virginia-based company called MicroStrategy began buying hundreds of millions of dollars worth of Bitcoin as a long-term corporate asset. By November 2021, Bitcoin had climbed to nearly $69,000 per coin, stunning financial analysts and portfolio managers around the world. Television screens in trading rooms across New York City showed the Bitcoin price chart moving upward like a rocket leaving a launch pad. But at that exact moment, something dangerous was building quietly inside the Federal Reserve headquarters building in Washington, D.C. Prices at grocery stores, gas stations, and housing markets across the United States were rising faster than they had in 40 full years. A shopping cart that once cost $100 to fill was now costing $115, then $120. Federal Reserve officials gathered around a conference table in Washington, D.C. and voted to fight rising inflation with aggressive interest rate hikes. Between March 2022 and July 2023, the Federal Reserve raised interest rates 11 times, pushing them to 5.5% at the peak. Each rate hike pushed investors on Wall Street away from risky assets like Bitcoin toward government bonds now paying real and reliable returns. Bitcoin collapsed during those months, falling from nearly $69,000 all the way down to $16,000 by November of 2022. That drop erased more than 75% of Bitcoin value in just over 1 year of Federal Reserve rate increases across the board. News cameras captured crowds standing outside cryptocurrency exchange offices in New York City, staring at their phones with visible expressions of disbelief. The connection between the Federal Reserve and Bitcoin had been exposed for the first time in the history of the digital currency era. When interest rates rise and money becomes tight, investors sell riskier assets quickly, and Bitcoin absorbs that wave of selling pressure first. But this story was far from over. The most dramatic chapter was still forming quietly in the financial background of global markets. By mid-2023, United States inflation had fallen from over 9% toward 3%, giving Federal Reserve officials new room to maneuver. Officials began delivering speeches at podiums across Washington, D.C., hinting that interest rate cuts were approaching in the months directly ahead. Bitcoin traders watching those speeches on screens around the world began preparing for what many believed would be a historic and powerful rally. Every statement Jerome Powell made at press conferences inside the Federal Reserve building, moved Bitcoin prices by hundreds or thousands of dollars in minutes. A single sentence about inflation slowing could send Bitcoin surging upward within minutes of appearing on live financial television screens worldwide. The digital currency market had become deeply sensitive to the language of traditional central bankers in ways that almost nobody had anticipated or predicted. In January 2024, United States regulators approved Bitcoin exchange-traded funds, opening the door to a historic flood of new institutional investment money. For the first time, ordinary Americans could purchase Bitcoin through regular brokerage accounts on Wall Street without ever needing to own a digital wallet. BlackRock, the largest asset management company on earth, with offices on Park Avenue in New York City, launched its own Bitcoin investment fund. Billions of dollars began flowing into Bitcoin markets daily from pension funds, hedge funds, and individual investors spread across the United States. Bitcoin climbed steadily through spring and summer of 2024, crossing $60,000 and pushing confidently toward what many believed was uncharted record territory. Financial television channels in New York City ran live celebration coverage with rising price charts and expert commentary filling screens around the clock. Then came September 18th, 2024, a day that Bitcoin investors around the world had been circling on their calendars for 2 full years. Inside the Federal Reserve building in Washington, D.C., officials voted to cut rates by 50 basis points, the first such cut since 2020. That cut was twice the normal reduction size and sent a bold and unmistakable signal to every financial market across the entire planet. Bitcoin surged immediately after the announcement. Trading platform screens worldwide lit up bright green as money poured back into digital assets at speed. In November 2024, the Federal Reserve cut rates again by 25 basis points, and Bitcoin kept climbing steadily toward new record highs. In December 2024, a third consecutive rate cut pushed Bitcoin above $100,000 per coin for the very first time in its recorded history. Images of six-figure Bitcoin prices on glowing trading screens spread instantly across social media platforms, from New York City to Tokyo to Dubai. Inside investment offices from London to Chicago to Singapore, portfolio managers scrambled to increase their Bitcoin holdings before prices moved any higher. The picture looked perfect. Falling interest rates, a rising Bitcoin price, and a new era of digital finance arriving exactly on schedule. But inside conference rooms at the Federal Reserve headquarters in Washington, D.C., officials were quietly reviewing economic data that told a very different story. The United States labor market was not cooling down. Employers across the country were still hiring at a faster pace than officials had expected. Inflation, though well below its 2022 peak, was not falling toward the 2% target quickly enough to justify continued rate reductions. On December 18, 2024, Jerome Powell stood at a podium in Washington, D.C. before live television cameras and delivered news that shook global markets. He announced the Federal Reserve would cut rates more slowly in 2025 than investors had been confidently pricing into their financial market positions. Where markets had expected 4 rate cuts during 2025, Powell now projected only 2, cutting those investor expectations directly and precisely in half. Stock index displays on the floor of the New York Stock Exchange fell sharply within minutes of Powell finishing his prepared remarks. Bitcoin dropped from above $100,000 toward $95,000 within hours of the press conference ending and cameras going dark on live television. Traders who had borrowed large sums to buy Bitcoin at record prices now face painful margin calls on digital trading platforms around the world. The vision of endless cheap money flowing into Bitcoin markets had just been interrupted by the most powerful financial institution on the entire planet. News reporters standing outside the Federal Reserve building in Washington, D.C. broadcast live updates about the wave of market shock spreading worldwide. It was a sharp and very public reminder that Bitcoin, despite all its decentralized technology, still moved with the forces of traditional finance. The invisible hand of central bank policy was reaching deep inside the world of digital currency and reshaping it with unmistakable and measurable force. In January 2025, the Federal Reserve held its first policy meeting of the new year inside its grand Washington, D.C. headquarters building. Officials reviewed fresh economic data showing inflation still sitting above the 2% annual target despite 3 consecutive rate cuts throughout 2024. After deliberating around the conference table in Washington, D.C., Federal Reserve members voted unanimously to hold interest rates completely steady at current levels. Jerome Powell appeared before television cameras at a press conference and told journalists the Federal Reserve felt absolutely no urgency to cut rates further. Bitcoin dropped below $95,000 for the first time in several weeks, erasing gains that had taken months of careful market momentum to build. Across trading floors in Chicago and Hong Kong, large digital price screens showed Bitcoin charts reversing direction downward in clear and visible real time. The pattern from 2022 was echoing again, not with the same intensity, but carrying the same unmistakable financial direction and underlying market logic. When the Federal Reserve signals a pause in easing, capital flows away from risky assets across the board, and Bitcoin reflects that change first. This was not speculation or opinion. Charts mapping Bitcoin price movements against Federal Reserve decisions showed a consistent and publicly documented pattern over time. Every major Bitcoin price peak in recent history had occurred during low-rate environments or during strong market expectations for imminent rate reductions. Every major Bitcoin downturn had coincided with rising interest rates or growing fears that high rates would remain in place far longer than expected. The Federal Reserve, created in 1913 to protect the United States banking system, was now actively shaping the behavior of global digital currency markets. Nobody present in the Senate chamber when President Wilson signed the Federal Reserve Act in 1913 could have imagined this extraordinary future connection. Yet the data was visible and available in public price charts and official policy documents that any researcher, journalist, or investor could easily access. A group of officials meeting inside a building in Washington, D.C. was moving a digital asset that existed entirely on computer networks across the world. The reach of monetary policy had stretched far beyond commercial lending and mortgage markets into the newest and most contested frontier of global finance. Bitcoin investors who once argued confidently that their asset was fully independent of traditional finance were watching that claim tested hard by real data. During extended periods of tight money and elevated interest rates, even the most decentralized digital instruments struggled to maintain and defend their market values. Financial newspaper front pages around the world described the situation with clarity. The Federal Reserve paused its cuts, and Bitcoin declined in direct response. Bitcoin fell roughly 15% in the weeks following the January 2025 pause, removing billions of dollars from total cryptocurrency market valuations. Investors who had built entire strategies around 4 Federal Reserve rate cuts arriving in 2025 were now being forced to rethink their entire approach. Those expected cuts had been delayed indefinitely, and financial markets were repricing every risky asset from technology stocks to digital currencies simultaneously. The Federal Reserve had not acted with any hostile intent. It had read incoming economic data carefully and responded exactly as it was designed to do. But the consequences were real and measurable. Bitcoin price charts on screens across trading floors around the world were pointing steadily downward each passing day. The story of Bitcoin and the Federal Reserve was no longer just an academic debate. It was unfolding in real numbers and real market prices daily. And the most important part of this story had not yet been fully told. The decisions still ahead would prove even more consequential than those behind. By February 2025, the Federal Reserve had made its position absolutely clear to every trader and financial analyst watching from global markets. Interest rates would stay elevated until inflation fell convincingly toward 2%, and that moment was not arriving as quickly as markets had hoped. Bitcoin, which had celebrated its $100,000 milestone just weeks earlier, was now trading in a range that reflected real institutional uncertainty. On trading floors, inside glass office towers in New York City, analysts revised their year-end Bitcoin price targets sharply downward for the first time. The most important question in digital finance had shifted from how high Bitcoin could climb to how long the Federal Reserve pause would actually last. To understand why this question mattered so deeply, you need to understand exactly how interest rates reshape the behavior of large institutional investors. When rates are low, government bonds in Washington, D.C. pay almost nothing. pushing investors toward higher returning assets like stocks and digital currencies. When rates are high, a United States Treasury bond paying 5% becomes an attractive and safe alternative to volatile Bitcoin price movements. Institutional investors managing pension funds for millions of American workers cannot afford to hold assets that swing 20% in a single month. A 5% government bond in Washington D.C. pays them reliably without the risk of watching their portfolio drop dramatically overnight without warning. This simple calculation explains why Bitcoin and interest rates move in opposite directions more often than financial commentators publicly acknowledge or discuss. When money is cheap and safe, returns are low, capital flows toward risk. When money is expensive and safe, returns are high, capital flows towards safety. Bitcoin sits at one extreme end of the risk spectrum, making it the first asset to surge when rates fall, and the first to fall when rates rise. Charts mapping this relationship from 2018 through 2025 showed the pattern repeating with a consistency that was difficult for even skeptics to ignore. In 2018, the Federal Reserve raised rates 4 times and Bitcoin fell from nearly $20,000 to just $3,200 by the end of that calendar year. In 2020, the Federal Reserve cut rates to near zero and Bitcoin climbed from $5,000 to nearly $69,000 over the following 18 months. In 2022, the Federal Reserve raised rates aggressively, and Bitcoin collapsed from $69,000 to $16,000 in one of its worst historical performances. In late 2024, the Federal Reserve cut rates 3 times, and Bitcoin surged past $100,000 for the very first time in its recorded financial history. The pattern was so consistent and so well documented in public data that major financial institutions began modeling Bitcoin as a rate-sensitive asset officially. JP Morgan Chase analysts in New York City published research describing Bitcoin as behaving similarly to long-duration technology growth stocks in rate environments. Goldman Sachs researchers in their Manhattan offices noted that Bitcoin price movements correlated strongly with changes in real United States interest rate expectations. These were not fringe observers. These were the largest and most influential financial institutions operating inside the United States economy in 2024 and 2025. The public research confirmed what the price charts had already been showing plainly to anyone willing to look at the historical data with open eyes. Bitcoin had not escaped the gravitational pull of traditional monetary policy. It had simply added a new and dramatic dimension to that familiar force. Back in Washington, D.C., Federal Reserve officials were examining fresh economic data arriving from labor markets and consumer spending reports every single week. The January 2025 jobs report showed employers across the United States had added 256,000 new positions, far more than economists had forecast or expected. A strong labor market meant workers were earning and spending, which meant prices across the economy were unlikely to fall quickly toward the 2% target. Federal Reserve officials standing at podiums in Washington, D.C. repeated the same careful message throughout the first quarter of 2025 with deliberate consistency. They would not cut rates until the data clearly and convincingly justified doing so. Patience, they said, was the correct policy position for the moment. For Bitcoin investors watching these press conferences on screens in trading offices from London to Singapore, that word patience carried a very expensive meaning. Every week of waiting for a rate cut was another week of Bitcoin remaining under pressure from elevated borrowing costs across the broader economy. By March 2025, Bitcoin had pulled back more than 20% from its $100,000 peak, settling into a trading range around $80,000 per coin. Financial news channels broadcast daily coverage from their studios in New York City, tracking each percentage movement with expert panels and real-time charts. Some analysts appearing on television screens argued that Bitcoin was simply consolidating before its next major move higher would eventually materialize and begin. Others pointed at the Federal Reserve data and argued that without imminent rate cuts, that next major move higher had no clear catalyst to trigger it. The debate inside investment offices on Wall Street was honest, genuine, and entirely unresolved, reflecting the real uncertainty spreading through digital asset markets. Meanwhile, something else was happening quietly inside the Bitcoin market itself that added another important layer to this already complex financial story. In February 2025, large Bitcoin holders known within the industry as whales began moving significant quantities of coins between digital wallets and exchange platforms. On-chain data visible to blockchain researchers tracking transaction flows showed large transfers appearing on public ledgers, maintained across distributed computer networks. These movements did not necessarily mean selling was imminent, but they signaled that large holders were repositioning their portfolios in response to the environment. Smaller retail investors watching these wallet movements on public blockchain tracking websites began growing visibly nervous about what the data might be signaling ahead. The psychological dimension of Bitcoin investing was being tested as severely as the financial dimension during this extended period of Federal Reserve policy uncertainty. One defining characteristic of Bitcoin markets was how quickly fear could spread from professional traders in New York City to retail buyers around the entire world. A single negative press conference at the Federal Reserve Building in Washington, D.C. could trigger selling waves on exchanges from Seoul to Buenos Aires within hours. This speed of fear transmission was something that traditional stock markets rarely experience with quite the same intensity or geographic breadth of impact. The Bitcoin network itself, running on thousands of computers spread across dozens of countries, felt every tremor from Washington D.C. policy rooms almost instantly. It was a paradox that sat at the very heart of this entire story and demanded honest examination rather than convenient dismissal or comfortable rationalization. Bitcoin was designed explicitly to operate outside the influence of any central bank, government, or institution anywhere on the surface of the entire planet. Satoshi Nakamoto had written in the original Bitcoin document that the network would give individuals control over their money without any institutional intermediary involved. The first Bitcoin block ever mined in January 2009 contained an embedded headline from a London newspaper, referencing a government bank bailout as its message. That detail was not accidental. It was a clear declaration that Bitcoin existed precisely as an alternative to the system that had just failed millions of people. Yet 16 years after that first block was recorded on computer networks, Bitcoin was moving up and down in direct response to Federal Reserve press conferences. The institution Bitcoin was designed to replace was now one of the most powerful forces shaping its price movements on exchanges around the entire globe daily. This was not a failure of Bitcoin technology. The underlying blockchain running on global computer networks continued operating exactly as Nakamoto had originally designed it. It was a reflection of who had entered the Bitcoin market between 2020 and 2025 and what their financial objectives and behavioral patterns actually were. When pension funds in Chicago and hedge funds in London bought Bitcoin through Wall Street exchange-traded funds, they brought traditional finance behavior with them entirely. These institutions sold risky assets when rates rose and bought them back when rates fell. And Bitcoin was now sitting firmly inside their official portfolios. Their buying and selling behavior now influenced Bitcoin price movements more powerfully than the actions of early digital currency adopters from the original 2009 era. The market had been institutionalized, and with that came the behavioral patterns and decision-making frameworks of traditional high finance permanently and visibly attached. Bitcoin had grown large enough to matter to Wall Street, and in doing so, it had allowed Wall Street to matter deeply to Bitcoin right back in return. Financial historians watching this dynamic from university offices in Boston and London noted that this exact pattern had appeared before in other emerging asset classes. Gold had once been considered a pure safe haven asset, fully independent of monetary policy decisions made by central bank committees meeting in government buildings. But after gold futures markets opened on the commodity exchange in New York City, gold prices began responding to interest rate changes with increasing regularity. Real assets, digital assets, and commodity assets all eventually became intertwined with monetary policy once large institutions began allocating capital to them at scale. Bitcoin was simply the newest and most dramatic example of a much older and very well documented pattern playing out across global financial markets over time. As spring 2025 approached, Federal Reserve officials in Washington, D.C. began delivering speeches that introduced a slight but meaningful shift in their public language. The word patient appeared less frequently. Officials began referencing incoming data more specifically and suggesting the path toward lower rates remained possible and open. Bitcoin markets, which had spent months under pressure, began showing signs of stabilization as investors monitored every word emerging from Washington D.C. with intense focus. Trading volume on major Bitcoin exchanges in Chicago and New York City began increasing again as investors positioned themselves ahead of potential policy shifts approaching. The memory of what had happened in late 2024 when 3 rate cuts sent Bitcoin above $100,000 was still fresh inside every trading room globally. Nobody wanted to be holding too little Bitcoin. If the Federal Reserve signaled a return to easing, and prices moved sharply higher very quickly in response. This anticipatory buying behavior itself demonstrated just how completely the relationship between Bitcoin and the Federal Reserve had become accepted market knowledge by 2025. Experienced traders were no longer debating whether the Federal Reserve influenced Bitcoin. They were strategically positioning portfolios around that relationship as an established fact. The conversation had moved from philosophy to strategy, from whether to accept and how to trade around what was now clearly a documented and repeating market dynamic. Looking at the full arc of this story from 1913 Washington D.C. to the Bitcoin trading screens of 2025 reveals something genuinely profound about financial power. Every new financial instrument that human beings have created across history has eventually encountered the force of central bank monetary policy in some measurable form. Railroad bonds in the 1800s, technology stocks in the 1990s, mortgage securities in the 2000s, and now digital currencies in the 2020s all followed this pattern. The tools change, the technology evolves, the names on the buildings and the language in the documents get updated for each new era of market innovation. But the underlying force remains constant. The cost of money, set by institutions in Washington, D.C. and other global capitals, shapes the behavior of every asset class. Bitcoin is not exempt from this force, and the data gathered between 2018 and 2025 makes that conclusion visible, measurable, and nearly impossible to dispute seriously. This does not diminish what Bitcoin represents as a technological achievement or as an alternative model for how money can be created and transferred globally. It simply means that in the current era of financial markets, Bitcoin trades within a world that central banks still powerfully shape and continuously influence each day. The Federal Reserve officials who voted to pause rate cuts in January 2025 were not thinking about Bitcoin when they reviewed their inflation and employment data. They were thinking about grocery prices in Ohio, and mortgage rates in California and hiring patterns in Texas, exactly as their institutional mandate required them to do. But their decision, transmitted through financial markets from Washington, D.C. outward, reached Bitcoin trading screens on every continent within minutes of being announced publicly. That is the nature of modern financial interconnection. Nothing operates in true isolation when institutional capital moves through global markets at the speed of digital information. Bitcoin began as a declaration of independence from exactly this kind of interconnection, and that original vision still lives inside the technology and its community today. But markets do not move on visions alone. They move on capital flows, and capital flows respond to the cost of money set in Washington, D.C. every 6 weeks. The Federal Reserve did not kill Bitcoin. It reminded the world that financial freedom and financial markets are two very different things that do not always move together. The building in Washington, D.C. that signed the Federal Reserve Act in 1913 is still standing, and the power that was born inside it is still very much alive. If this story moved you, hit subscribe button. The past holds powerful lessons, and I will help you uncover them.